Financial Analysis from A to Z Episode 2. Let's go down the margin cascade, from revenue to net profit, step by step through the income statement. Net profit does not fall from the sky. Between revenue and it lie several tiers of the income statement. They show where value is created, and where it is lost. Let's take DistribPlus again. On the agenda, the tiers of the margin cascade. Gross profit and value added. EBITDA, the pure performance of the trade. The path down to net profit. And operating cash generation, with its traps. Chapter 1. The margin cascade, several successive tiers from revenue to net profit. The margin cascade breaks the making of profit into successive tiers. Each isolates a step, the trade, the value added, the operations, then the financing. That is how you can compare a company with its sector. Here is the cascade. Gross profit, sales minus cost of sales. Value added, the wealth created. EBITDA, before depreciation and interest. Operating profit, the EBIT. And finally net profit, after interest and tax. Why the cascade changes everything. At DistribPlus net profit falls, but where exactly? The cascade answers. Gross profit holds, it is EBITDA that gives way under staff costs. Without the tiers you would treat the wrong problem. What the tiers are for. Locate the exact cause of a fall in profit. Compare two firms despite different structures. Position the firm against its sector average. And track a trend over several years. Chapter 2. The first two tiers, gross profit and value added. First tier, gross profit. For retailers it is sales minus cost of sales. For a retailer like DistribPlus it is the nerve of the trade. A single point of margin lost quickly means hundreds of thousands of pounds. Let's read the gross profit of DistribPlus. Sales rise to 48 million. But cost of sales rises faster. Gross profit falls from 11.3 to 11 million, and the margin loses a point. Second tier, value added. It measures the wealth truly created by the company, the output less bought in goods and services. This wealth is then shared between staff, the state, the lenders, and the company itself. For makers, the first tier changes. A manufacturer does not resell, it makes. Its starting point is not gross profit but output for the year. Goods sold, goods put into stock, and those made for own use. Look at the sharing at DistribPlus. 62% of value added goes to wages, 8% to tax and rates, 9% to lenders. 21% is left for the company. The sharing tells you a lot about a model. The sharing shifts at DistribPlus. Value added stalls, but the staff share rises. Mechanically, what is left for the company, EBITDA, shrinks. The problem is not revenue, it is the sharing of the wealth created. Chapter 3. EBITDA, the true benchmark of operating performance. The most watched tier, EBITDA. It is value added less staff costs and operating taxes. It ignores depreciation and financing, it is the pure performance of the trade, the gross operating result. Why is EBITDA king? Because it is insensitive to depreciation and financing choices. Two companies can carry very different debt. EBITDA compares them fairly, on the trade alone. At DistribPlus, EBITDA falls from £3,100 to £2,600,000, that is 16% in 1 year. the EBITDA margin loses 120 basis points. The trade itself is worsening before any accounting effect. The ratio to remember, EBITDA set against sales, the EBITDA margin. It is the most universal performance ratio. It says how many pence of potential cash each pound of sales throws off, before depreciation and financing. Reading EBITDA properly. Set it against sales, never in absolute terms. Compare it with the sector average. Watch its trend over 3 years. And see it as potential cash, not cash already received. The value-added ratio also tells the model. A high ratio signals a deeply integrated firm that does much in-house. A low one, a trading business that buys and resells, outsourcing a lot. Each sector has its norm. Chapter 4. From EBITDA down to net profit, what depreciation, interest and tax take away? The path to the bottom line. We start at EBITDA. We deduct depreciation and reach operating profit, the EBIT. Then interest and tax. What remains is net profit, what belongs to the shareholders. Let's roll the DistribPlus figures. EBITDA at 2.6 million. We deduct 1.4 million of depreciation, landing at 1.2 million operating profit. After interest and tax, net profit reaches £1,200,000. One tier deserves attention, profit before tax, the PBT. It adds operating and finance results, before tax. It is the recurring profit of the business, what you project forward, unlike a one-off gain on a disposal. One item to isolate always, exceptional items. Disposals, settlements, claims, they do not repeat from year to year. A gain on a disposal can flatter a falling bottom line. You always strip them out to judge recurring performance. One measure links to cash generation. It starts from net profit and adds back the non-cash charges such as depreciation. It approaches the liquidity the trade throws off, enough to invest and to repay without borrowing. Chapter 5. The reading mistakes on margins, and everything ActioFin gives you. 3 traps on margins. Watching only net profit, which aggregates everything. Confusing EBITDA with cash, when it is a performance tier. And forgetting the sector, 3% margin is weak in industry, normal in retail. All of ActioFin for your margins. The complete, free course, chaptered like this series. The margin calculator from your income statement. The workshop to break down a real cascade. And solver to interpret a tier with sources. The bridge to episode 3. A tier in pounds cannot easily be compared across firms. For that you turn it into a ratio, a percentage, a turnover, a number of days. That is the next episode. The cascade in 2 ideas. The method, several tiers from revenue to net profit, to see where value is created and lost. The reading, watch the tier and not just the bottom line, and always compare with the sector. Second episode done. You can now go down the margin cascade and spot where value is lost. Find the free course and the margin calculator on ActioFin. In episode 3 we turn these tiers into ratios, profitability, liquidity, solvency. Put these margins to work on ActioFin.com. Subscribe, and see you soon.